Hello, everyone, and welcome. Let's talk about something that affects so many of us, taxes. Specifically, are you absolutely certain you're not leaving money on the table when you file? It's a big question, especially when you start trying to figure out the world of tax credits. So today, we're going to pull back the curtain on some of the most important credits out there, the ones for your spouse and for your dependents. You know, getting this right can make a huge difference to your bottom line. So let's really make sure we understand how this all works.
All right, let's get started with our detailed exploration of these tax principles.
So, here's our game plan for today. First, we'll break down what tax credits actually are. Then, we're going to jump into two real-world case studies, one with a married filer and another with a single parent. We'll also tackle that common question about child credits. And finally, we'll wrap it all up by summarizing the key principles you absolutely need to take away from this.
Okay, first things first, let's get down to basics and really understand the foundation of how we reduce our taxes.
You know, before you even think about pulling out a calculator, this is the question you have to start with. Think of your family situation as the key that unlocks everything else. It really dictates which credits you can even consider. Are you married? Are you single? Do you have children? The answers here are going to change everything on your tax return. All right, so the specific type of credit we're digging into today is called a non-refundable tax credit. I find the easiest way to think about this is to picture it like a coupon you use at the grocery store. It directly reduces the bill you have to pay, right? These credits do the exact same thing for your tax bill. They can slash it, maybe even all the way down to zero. But, and this is the really crucial part, it's non-refundable. That means if your tax credits are worth more than the tax you owe, you don't get the difference back in cash. The government doesn't give you change, so to speak.
Okay, theory's great, but let's make this real. It's time for our first case study. We're going to look at a married couple, Kami and Bob, and we'll calculate the credits for them.
So here's the breakdown for Kami and Bob. As you can see, Kami is the primary income earner with about $96,000. Her husband, Bob, has a much lower net income of around $8,600. They're married and they have 4 kids. Now, another key piece of information here is that Kami's employer has withheld the maximum for CPP and EI. That's your Canada Pension Plan and employment insurance. And as we'll see, that's important because those contributions actually generate tax credits for her.
All right, every single taxpayer in Canada starts with this fundamental building block. It's called the Basic Personal Amount, or the BPA. The easiest way to think of it is as a base level of income that you can earn completely tax-free. For the 2021 tax year we're looking at, that amount is $13,808. So for Kami, this is the very first credit she gets to claim.
Okay, so this brings us to the central question for this couple. Can Kami claim a tax credit for her spouse, Bob? Well, remember that basic personal amount we just talked about? Bob's income is less than that amount. And because of that, Kami might be able to claim what's called the spousal amount. It's basically a way to transfer his unused credit over to her.
And you know what? The math here is actually pretty simple. It's a 3-step process. First, you start with that full base amount, the $13,808. Step 2, you just subtract the spouse's net income, in this case Bob's $8,650. And boom, step 3, the result, $5,158. That's the amount Kami can claim as the spousal credit. See? Not so bad.
So let's put it all together. You can see we're starting to build up a nice little stack of credits for Kami. We've got our own basic personal amount, that's the $13,808. We add the spousal amount we just figured out, the $5,158. Then you add in credits for the maximum CPP and EI she paid. And finally, there's the Canada employment amount. That's a standard credit for pretty much anyone who earns employment income.
Okay, we've gone through Kami's credits, but I know what you're thinking. Wait a minute, what about the 4 kids, right? Surely they must generate some kind of tax credit. This is probably one of the most common points of confusion in Canadian taxes. And the answer? Well, it's not what most people expect.
And this is where we need to be crystal clear about a really important difference. We have tax credits on one side and government benefits on the other. They are not the same thing. A tax credit, like the spousal amount, reduces the tax you have to pay. A benefit, like the Canada Child Benefit, is actual cash the government sends to you. One is a reduction, the other is a payment. Totally different.
So to answer the question for Kami, her children's information is absolutely vital, but it's for calculating her Canada Child Benefit, those cash payments. In her specific case, since her kids are healthy and don't have their own income, they don't actually create any additional non-refundable tax credits on her return. It's all about the benefits for them. Okay, let's switch gears. We've seen a married couple, now let's look at a completely different family situation. We're going to dive into a case for a single parent named Scotty, and this will help us understand another major credit, the eligible dependent amount.
Now, Scotty's file looks quite different from Cammie's. First off, marital status is single. That's a huge factor. The income source is spousal support, which means no candidate employment amount. And here's an interesting twist. Scotty has 3 kids, but one of them, who's 15, actually has their own net income of over $8,000. That's going to be important.
So because Scotty is single and financially supporting a child, there's a different credit that comes into play. It's called the eligible dependent amount. You'll often hear it called the equivalent to spouse amount, and that's a perfect name for it. It's designed to give a single parent a credit that's, well, equivalent in value to the spousal credit a married person might get.
Now, here is a rule you absolutely cannot forget. Even though Scotty has 3 children, you can only claim this credit for one of them. Just one. So you have to pick which child to claim it for. And, strategically, you'd want to choose the one with the lowest income to get the biggest possible credit.
And guess what? The math is exactly the same as what we did for the spousal amount. It's a familiar pattern. You start with that same base amount, the $13,808, and you simply subtract the net income of the one child you've chosen to claim. So if Scotty were to claim the 15-year-old, that credit would be significantly reduced by that child's income.
Okay, we've walked through 2 very different case studies. So let's take a step back and pull out the big picture rules, the core takeaways from all of this. All right, here are the guiding principles you really need to lock in. First, marital status is everything. It's the fork in the road that sends you toward either the spousal amount or the eligible dependent amount. Second, and this applies to both credits, the income of the person you're claiming, whether it's your spouse or your child, will always reduce the amount you can claim. Third, and this is so important, you can only claim one of these equivalent to spouse type credits. You get one, not both. And finally, your best friend in all of this is Schedule 5 of the tax return. That is the official worksheet where all these calculations happen.
And look, don't just take my word for it. The Canada Revenue Agency itself points you right to the source. As they say on their website, for all the detailed explanations, you need to refer to Schedule 5. That's the ultimate authority, the rulebook for these credits.
So now you know the rules, but knowing them is just the first step. The real challenge is applying them correctly to your own unique family situation to make sure you're truly maximizing what you're entitled to. So I'll leave you with this to think about. Are you absolutely certain you're getting every credit you deserve each year? It's a question worth asking. Thank you for your time.